Hi everyone, couple of things I wanted to mention to you that I've covered on the Telegram channel already for Pips Predator, but I wanted to show you with Brent. This is what we're looking at. Brent, March 21 hour time frame, which is what we started off with last week, remember, and what I gave you the heads up on the Telegram channel. So that's when we got our buy signal. Just a quick update for those who don't know how we get our buy signals. Remember, it's based on our algorithm, which tell us pattern recognition based on some clever artificial intelligence libraries that we've built up on Microsoft Azure, plus multiple indicators over multiple time frames and some price confirmation and moves. Anyway, that you can see on Pips Predator and also where to get the Telegram app. What I wanted to say to you here is, first of all, yes, we got the signal, and then we've got this buy, okay? You know that the red dotted line means we're adding to our position. You can see the numbers where we add to it here and what the original buy signal was and the various stop losses for each of those. That's all fine. I want to talk to you first about dynamic and stepped stop losses. That's the first thing, and this trade in Brent is ideal to illustrate that. And secondly, I want to talk to you about hedging. Both of these things are to do with making money, all right? So pay attention. First of all, you see this, and you saw what happened. The price first went up, went down, very close to our stop loss, and then went up. Now, imagine you had a dynamic stop loss. What's a dynamic stop loss? A dynamic stop loss is one which just follows the price almost point for point and behind it. So if as this went up, this stop loss would have moved up. And as this moved down, this stop loss would have been hit at some point, okay? If it got hit, you would have exited and then missed the trade because the price went up. That's the downside of a dynamic stop loss. So why would anybody ever do a dynamic stop loss? Well, they do it because they say to themselves two things. One is, let's imagine it didn't go back up, but instead it went down and down and down and down. Well, at least they got out quickly at a small loss. Okay, so that's one reason for doing the dynamic stop loss. The other thing they say to themselves is, I don't mind if it went down and then went up because I can always re-enter. And they'll create their own reentry rules. One which is quite common is they'll say, well, if it goes up like this, I'll mark that as a high point, and then it drops down. And if it stops me out, let's say here, I'll wait and see if it goes back above this high point, and I'll get back in. Now, that might be a bit more complicated. It's something we used to do manually before. It's some what my apprentices do, but it's entirely up to you whether you use that more complicated manual approach. The alternative is, and my preferred approach, is a stepped stop loss, which is where you say, right, I'll give this trade ample room to move. Okay, and the reason I'll give it ample room to move is because it might, as it has done, go up here. And what I'll do is only when it hits a level, let's say a level like this, where we're going to add to our position, which is written here, will I move this stop loss up. Now, the advantage of that is it gives you the position a lot more room to move, but you still keep a stop loss. So that's a step stop loss, and you can see the pros and cons. It's my preferred approach. It's what I also know a lot of apprentices appreciate. Not all brokers offer step stop losses. If they don't, ask them if they do or not, and then switch brokers if they don't. All right. Remember, all of this is on my Telegram channel as well, which is where you might be watching it right now, but in case you're not. Now, the other thing I wanted to talk about was hedging. Right, so let's just look for a moment at the 15-minute bar, all right, which is where we are here. Let's bring it right back up to date in the 15-minute bars. Now, on the 1 hour, we were still long. Okay, on the 15-minute, we had a short signal ages ago. All right, well, this morning, right, we had this. Now, I've not put in the dotted line where we add to our winning position, but that's written here anyway. That doesn't matter so much at the moment. What we want to do with this trade is this. We've got the short position down here. Oh, by the way, I should say this is version 6, which we've not launched to the public yet, but version 4 should show you very similar results. Okay, version 6 will be launching shortly, but for now, in case anybody's watching this thinking, I haven't got this version, it's still being trialed by me until we're ready to launch it in the next few weeks, and you'll all get an email who are Pips Predator apprentices. So we're shorting. We're making profits while this falls, and we're making profits on the 1 hour time frame. The advantage of that, if we go back here and we look at this earlier trade here, the advantage of that is whilst we had a buy signal, which came in very nicely, by the way, because obviously these patterns triggered something on our library of patterns and said, whoa, the market's ripe for a rise up. We didn't know it was going to be a Trump-based assassination, but the market was ready. It could have been other news. If no news came, the market might have just gone sideways and nothing would have happened. But instead, this assassination thing happened. So this shot up. what that allowed us to do when we got this short was to hedge the 1 hour bet. So that's what I mean by hedging. You've got the ability to do that. Now, some of you might equally say, hang on, Alpesh, wait a minute. Look, what about all these multiple indicators? Now, these are just traffic lights for us to give us some indication. And people, whenever they see that happen, they might say, well, I'm not going to wait for an exit signal. I'm not even going to wait for the trailing or stepped stop loss, which will move in, blocks of whatever that distance is. That'll be the first time it moves down there and then moves down here and so on. I'm just going to get out because I see this. That's entirely up to you. We give people lots of different approaches. We tell them what we prefer, which is the trailing stop loss, stepped. But some people say, no, as soon as these all go in the opposite direction to the trend, because the trend is downwards, but these are all pointing up, I'm going to get the hell out of there. That's obviously one option. The alternative, like I said, is that they just do what we do, which is just have the step stop loss. Now, you don't need to be at the screen for any of this, of course, because you might have, rather than being at the screen, you might have just done this and left it as a trailing stop loss and gone. And that's even better because you won't overtrade or second guess. So hopefully that's gone into a lot of detail on trailing stop losses, different types, and on hedging. Thanks very much.